The best dividend ETF can enhance the performance of your portfolio and help you achieve the highest risk-adjusted returns feasible. However, it's important to know that dividend ETFs employ different strategies. They can be categorized into high dividend yields ETFs and dividend appreciation ETFs. Our list of the 7 best dividend exchange-traded funds looks at both high dividend yields ETFs and dividend appreciation ETFs. And stick around to the end for our pick of the absolute best dividend ETF for your portfolio. First on our list is VYM, Vanguard High Dividend Yield ETF. It has an expense ratio of 0.06% and total assets of $52.6 billion. Vanguard is renowned for its low-cost ETFs with high diversification, and VYM is no different. This ETF follows the FTSE High Dividend Yield Index, comprising over 450 large-cap U.S. stocks selected for their high yields. VYM is broadly diversified and spans all 10 stock market sectors, but it leans slightly towards consumer staples and financial services. Here are the pros. The fund is highly diversified across multiple sectors. It has a very low expense ratio of 0.06%, and its turnover rate is low. The cons? VYM has a slight concentration on financial sector stocks. It has relatively low exposure to mid-cap stocks, and there is really no exposure to international stocks. Number 2 on our list, SCHD, Schwab US Dividend Equity ETF. This fund has an expense ratio of a meager 0.06% and $53.8 billion in total assets. If you are seeking a dividend ETF with a robust screener, SCHD is a viable option. The fund tracks the Dow Jones US Dividend 100 Index and comprises 100 stocks chosen for their strong dividend, sustainability, and solid financial ratios. Unlike Vanguard's high dividend ETF, SCHD has a more focused portfolio with significant holdings in AbbVie, Amgen, and Cisco. And SCHD offers one of the highest payouts among top dividend ETFs at over 3%. Here are the pros. The ETF offers higher than average yields. Its holdings are screened for quality, and the dividends are screened for sustainability. But there are a few unfavorable factors as well. One is the fact that SCHD has a notable concentration in stocks within the healthcare and financial sectors. Also, there is no exposure to small cap stock, and you will need to consider that the portfolio has fewer holdings and a higher turnover rate. ETF number 3, DLN, the Wisdom Tree US Large Cap Dividend Fund. DLN has an expense ratio of 0.28% and total assets of $3.9 billion. This fund follows the Wisdom Tree US Large Cap Dividend Index and is composed of 300 of the biggest business firms by market cap from the wider Wisdom Tree US Dividend Index. But unlike certain dividend ETFs, DLN assign weights to its holdings based on projected dividend rather than solely on market capitalization. Consequently, companies that are expected to offer higher yields receive greater representation in the ETF due to this underlying weighting methodology. Here are the pros. You get a balance of growth and income. You also get a fair bit of diversification, and the holdings are weighted based on projected yields. But there are a few drawbacks as well. The weighting methodology leads to higher turnovers. The 0.28% expense ratio is rather high, and dividend yield is on the lower end. Number 4, ProShares S&P 500 Dividend Aristocrats ETF, NOBL. NOBL has an expense ratio of 0.35% and total assets of $11.9 billion. ProShares is widely known for its collection of leveraged ETFs. However, it also offers lesser-known treasures like NOBL. ProShares S&P 500 Dividend Aristocrats concentrate on the 67 Dividend Aristocrat stocks in the S&P 500 and allocates its investments across these stocks relatively evenly. The companies in the NOBL portfolio have demonstrated consistent dividend payments and growth for a minimum of 25 consecutive years. Over time, this investment strategy has proven effective for NOBL in reducing volatility and minimizing downside risk, particularly during periods of market instability. In summary, here are the pros: higher weighting to defensive sectors like consumer staples, a more evenly distributed, nearly equal weight allocation of equities, and finally, the ETF has a low tracking error, which is an often overlooked cost of ownership. The cons: NOBL is a very concentrated portfolio with only 67 holdings. The 0.35% expense ratio is rather high, and dividend yield is on the lower end. Up next, number 5, DGRO, iShare Core Dividend Growth ETF. It has an expense ratio of 0.08% and total asset of $26.4 billion. DGRO is BlackRock's primary dividend ETF in their low-cost core lineup, holding over 400 stocks from the Morningstar US Dividend Growth Index. It focuses on companies with a history of increasing dividend and includes top holdings like ExxonMobil and Chevron, which are known for paying huge dividends. Here are the pros. The fund has a low expense ratio of 0.08%. It is well diversified, and it has a good balance between sectors. So what are the cons? First, the fund has no international stock exposure. It also has limited exposure to small cap equities, and it has a noticeable high turnover rate. Up next, number 6, SPDR S&P 500 ETF, SDY. SDY has an expense ratio of 0.35% and total assets of $20.3 billion. If you're looking for an alternative approach to targeting dividend aristocrats, consider SDY, which follows the S&P 500 High-Dividend Aristocrats Index. SDY evaluates its stocks based on a minimum of 20 years of uninterrupted dividend growth. Stocks in SDY's portfolio are ranked by yield and rebalanced every quarter. The ETF allocates weights to its 139 existing holdings. This strategy reduces the emphasis on particular sectors like technology and communication services, compared to other dividend ETFs, which typically use market capitalization or almost equal weighting methods. Here are the pros. SDY allocates higher weights to higher yielding stocks. Stocks in its holding have a history of dividend growth, and SDY has a long history of performance. But there are some cons. SDY's portfolio is concentrated with fewer holdings. It has a high expense ratio of 0.35%, and it is lacking in its exposure to certain sectors. ETF number 7, DGRW, Wisdom Tree US Quality Dividend Growth Fund, ETF. This ETF has an expense ratio of 0.28% and $12.3 billion in total assets. DGRW employs a rigorous dividend investing strategy by following the Wisdom Tree US Quality Dividend Growth Index, which selects dividend-paying stocks based on growth and quality criteria that are derived from long-term earnings and growth projections. The ETF also uses a special weighting methodology based on a stock's projected upcoming payout rate. Stocks projected to pay more dividend are weighted more heavily. The total portfolio of DGRW includes some 300 equities, with the highest yielding sector in technology. So what are the pros? This ETF has some exposure to growth stocks. It screens its holdings for quality factors, and as stated earlier, DGRW weighs its holdings based on projected upcoming yields. But there are some drawbacks with this ETF. It has a higher turnover rate, the 0.28% expense ratio is on the higher end, and dividend yields have been lower. Dividend ETFs can serve as a strong fundamental component in your income-focused investment portfolio. They provide simplicity, accessibility, and diversification advantages over selected individual dividend stocks. As an investor evaluating dividend ETFs, you should concentrate on their strategies, holdings, their expense ratios over solely chasing yields. It's crucial you understand the distinction between US and international holdings, as well as between high yields and dividend growth, and various equity styles to identify the right ETF for you. Our top pick for the best dividend ETF is SCHD, Schwab US Dividend ETF. It's selected for its low expense ratio, competitive yield, high analyst ratings, strict index methodology, and impressive historical performance. Go ahead, leave us feedback and share your thoughts in the comments. And if you found this information helpful, smash the like button, subscribe to the channel, and share the video with someone who could benefit from it. Until next time, stay financially savvy. We'll see you in the next video.